Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Reema and Nigel. Guys, good morning.
Hi, good morning. Brand new week, and there's lots to track other than Trump comments. The conflict has now entered day 37. But this week, we've got the RBI monetary policy, and we officially kickstart the earnings season with TCS on Thursday.
Well, that's right. And Easter Monday, so some global markets will be shut as well. Participation could be relatively lower the day after Easter Sunday. So let's see how it goes. Something's got to give. I guess we've got a couple of days more before something has to give. Either it escalates or de-escalates.
Nigel, when's the next market holiday?
I'm not sure.
Midweek. I think it's the week after this one.
14th.
Oh, I've been told 14th.
That's the next one.
That's the next one.
Okay, all right. Let's just take it from the top then, right, in terms of where we are at. This is, by the way, week 6 of the conflict. It's week 6 of this conflict, but it's almost been 1 year since, if you remember, Liberation Day, right? When President Trump stood in that, White House gardens with that placard and sort of read out tariffs which each country will see. So 1 year since Liberation Day, that was an absolutely chaotic period, and I think this is no different either. It's a different set of circumstances. It's geopolitics, it's oil, but it's chaotic like it was back then. So let's just take it from the top, right? I mean, Brent oil around the $110 a barrel mark as we sort of, begin this session. This is, of course, the move. So, first 3 weeks, basically, you had escalation. Week 4, you had a little bit of de-escalation. Last week was the first time that oil prices actually came off a little bit. Otherwise, they've been rising to being flat since this war began for about 5 weeks now. Now, President Trump said a lot of things over the last 3 days that we've been, of course, on holiday, 2 days of the weekend, Saturday, Sunday, and Friday, of course, was markets shut. So he's basically warned. The latest and the most important consequential thing is he's warning Iran that he will significantly escalate the war if the Strait of Hormuz remains closed. And he put this post up, and I just want to sort of, put this up, of course, has been roundly and fairly criticized by all and sundry for the language and, of course, what it does say, destruction of civilian infrastructure. He's saying, well, power plants, bridges, everything. I mean, I think it's a bit crazy, if I can put it bluntly, but that is where we are at. It does, of course, at some level sort of reek of desperation. At another level, of course, this has to be read as a threat. And by the way, the deadline for the threat is Tuesday, or rather actually Wednesday early morning. But, you also had the U.S. Central Command, which said that it is continuing its strikes on Iran. This, of course, happened in the last 24 hours or so. There was, this U.S. service member who was in Iran. He was rescued. And then, the U.S. Central Command said that strikes have begun once again. There's a press conference as well by President Trump. This is on Tuesday at 10:30. That is tomorrow night at 10:30 p.m. So the press conference tomorrow night, and the deadline essentially for Iran for them to actually open the Strait of Hormuz sometime our time, early Wednesday morning. But these deadlines and these timelines, etc., have kept shifting. A few days, 48 hours, 5 days, 8 days, etc., etc. We'll see where this really goes. But for all practical purposes, the situation is largely unchanged. The strait, of course, is closed. Some ships are passing, oil markets, of course, are reacting and watching this very closely. There was a response from the Iranian side as well, and this is what he said. It was basically directly addressed to President Trump. He said, "Your reckless moves are dragging the U.S. into a living hell." That's the full quote of it. Make no mistake, you won't gain anything through war crimes. So this back and forth between both sides continues. I'll just touch upon price action for a bit. So S&P last week closed just a smidge below its 200-day moving average. That number is 6,644. We left off about 100 points away from that level. First quarter earnings in the US kick off from Wednesday. We'll see where that really goes. But, I mean, US markets have sold off. I mean, they're, I think, what, 3.5% from all-time highs, but we've not seen a very large correction or anything yet. Here in India, the RBI sort of MPC kicks off today. The decision is on Wednesday. Most likely rates are going to be left unchanged. But the commentary after everything that the RBI has done, some big moves last week, by the way, on the rupee, and the rupee went up very, very sharply, about 2% on Thursday, which was the last trading session. I mean, I think it'll be interesting to see RBI's thoughts on that. TCS will kick off earnings season. That is on Thursday. Some of the other IT companies are not kind of sort of reporting right after TCS. They are kind of spread out through the course of the month. Actually, they report later in the month, in April. And I'll just sort of leave off with levels, since not very much has changed and we are in a status quo with regards to where we really go from here. Those are the levels. 22,941. We left off at 22,713. The resistance is 22,941, which is the swing high. Then you go to the channel resistance, which is 23,110. And then you got to be open to the possibility of 23,500 or so as well. So those are levels on the upside. The near-term support, the very near-term support, stands at about 22,040 or so. GIFT Nifty up on your screen. We saw, by the way, on Thursday, which is the last trading session, this remarkable pullback from the lows, and we ended absolutely flat. So this morning, GIFT Nifty indicating an implied open of about 90-odd point cut. So that's the picture. Let's take it with the F&O cues and the positioning. Nigel, take it away.
Well, the geopolitical tension globally is still very much uncertainty. The market's guessing what the US as well as the Iran leadership will do next. Though we witnessed a very good recovery actually in our markets on Thursday, the bigger positive though was finally we see some kind of stability and some solid strength in the Indian rupee, and that was really heartening to see. However, the FIs, well, they continue to remain big sellers in the cash market. But hope is that the rupee finally stabilizes, and since the Nifty in dollar terms is back to 2021 levels, this massive FI selling gradually eases out a little bit. There was no sign of short covering, though, from the FIs. They added, in fact, more shorts than long positions on index futures, while they added positions both on the long as well as on the short side on stock futures itself. The positive, though, was that they wrote more puts than calls. That was actually heartening to see. On the option side, there was a fair bit of addition on the 23,000 call. And on the downside, the 22,300 put, both of them did see a fair bit of addition. The broad sense in terms of the range, well, on the downside, 21,700 to around 22,200. That's the crucial support. That really, that mark is the Liberation Day low, as well as the recent low that we saw. Well, the resistance level comes in at around the 23,200, which is the recent high. And even the options data suggests that maybe that 23,200 will be the first hurdle for the bulls on the upside. My gut feel is we don't breach the Liberation Day low and we move on from here on. The India VIX, well, it's cooled off from around 29 odd that we saw in the past week. That number, though, gradually needs to correct to around the 20 odd mark. Also, the rupee holding on to the gains that we saw in Thursday's trading session. That's going to be extremely important. As I said, the FIs have been big sellers. In dollar terms now, the Nifty is at the same levels that we saw in 2021. So if that selling can ease out a little bit, it'll be good news from a bullish perspective.
All right, let's just quickly take stock of the Asian markets this morning. As Nigel was saying, many Asian markets are shut today. You've got China, Hong Kong shut on account of Qingming Festival. Taiwan is shut for tomb sweeping. And later on, France, Germany, UK all shut on account of Easter. In fact, even Australia and New Zealand are shut. So the ones which are trading today, we've got the Nikkei. That's up close to about 2%. And we've got the Kospi. That's up 2.5%. So just two markets in Asia to track this morning. Conrad Saldana, Managing Director, Portfolio Manager at Neuberger Berman, is here with us in the studio. Conrad, it's so good to see you in person. It's always, across Zoom, but great to have you. What brings you to India and what's the key agenda here?
I'm just seeing companies and also had a nice little break out in Rajasthan. I think it helps with the weaker rupee too. But Jenny, just trying to get an update on the markets.
And have you got an update? What's been the key sense so far? Or
It's still early. I think, people are reasonably optimistic, but I think the global backdrop is not conducive. And I think the external factors, whether you're thinking of oil sustainably above $100, and seeming to be sticky and moving higher is an issue. You're talking about external factors, including the Treasury yields that are flirting with 450 basis points. You're seeing mortgage rates also in the U.S., right, well above 6%. So there's a little bit of a fear factor and risk on that receded right early in the year prior to the invasion, and it's not helpful that you're having the market deal with constant tweets on the current geopolitical crisis. That's not helpful. So a lot of external factors pressuring. When we came into this year, we were talking about the earnings cycle needs to start to inflect. You saw FI selling because you're seeing better opportunities elsewhere. We were talking about AI loser bucket for India, and I think that's just been compounded now with the whole oil factor and the pressure on the rupee as well.
Conrad, good that you had a nice break, and with the weaker rupee helping. But I mean, if you're taking a holiday out, you're at a bit of a disadvantage, right? I mean, with the weaker rupee. So I just want to stay with rupee for a bit. Fridays, you saw last Thursday's big recovery, right? The rupee was stronger by 2%. And the market also pulled back up. Just a technical question. When foreigners bring and put money in India, I mean, they hedge some portion of it, right? Yeah, go on. So, Prashant, I'm just trying to understand what happened on the rupee on Thursday and the very sharp recovery in markets. And I mean, was there a connection or what?
Yeah, I'm not sure fully there's a connection. There's potentially behind the scenes, there's potentially the RBI trying to do a backstop on the rupee. And currencies is a bit of a mug's game because you see traders pile on very aggressively and then they start to unwind some of those positions. So all of those could be a confluence of what happened on Thursday. You get into an oversold territory and there's a bit of paring back, right, of those exposures. Usually for long-only investors, there is no hedging. So the index itself, when you look at it, whether it's the local index or the MSCI or FTSE, those are unhedged indices. So long-onlys would not hedge those exposures, especially on the equity side. Now, you would have hedge funds and others that would be trying to hedge out the rupee exposure if they want to get just idiosyncratic risk into equities or on the fixed income side. But by and large, for long-only investors, there is no hedging.
Passive, active, both. I mean, there's...
Correct. 100% on
this doesn't make that much of a difference. And
that's correct.
In terms of signaling effect, I'm not sure. I mean, typically, a stronger rupee is on the back of stronger flows, FDI, et cetera, right? This is not that confluence. This is essentially the RBI trying to cut people out and sort of, push back against speculative positioning.
You're setting a floor, right? I mean, you're moving from 90 to 95. You're like, what's the next stop? And then you see the market starting to draw a straight line, extrapolated out to 100. And so at some point, I think there's a putting a floor on it.
Yeah.
All right. Hi, Conrad, and belated Happy Easter to you, your family, and hope you had a good one here in India.
Same to you, Nigel.
Well, Conrad, I wanted to ask you about, the sectors that we were talking about last time around. You made this point, post the global sell-off. Tech names, whether it was Cognizant, Accenture, they were trading at 10 to 15 times, or some of them even in single-digit PE. And I think you made this point that you liked Persistent, Coforge. I think so. Both those two stocks were on your list. That call actually has worked out fairly decently in the last 1 month because tech has outperformed. Would tech be a sector that you'll be looking to load up on post the sharp underperformance that we've seen in the last 18 months or so?
Now, I'm not sure in the next week or few weeks, Nigel, but my belief on tech earlier one was that how do they get beyond the time and material, right, billing cycle? And you can't have a confluence of where software is going to be entirely dead and AI, every company is going to do their own software stack without any services. So my view is that the companies that are well positioned for it, some of the smaller names, more nimble, provided more services, engineering services, are going to do well. You've seen even deals with the likes of Infosys, right? And so I do think that valuations are supportive for the sector. Obviously, in the nearer term, the rupee depreciation has helped, and there's a little bit of flight from people moving away from domestic sectors, including the banks, and moving it to IT services. But if I take a longer-term view to it, IT services, right now, there's not being much priced in for it. So the better players' growth has been lackluster. They're going to start to inflect positively. So I think the worst is priced in. And what I look for from a longer-term investment standpoint is where is the valuations totally misaligned with the fundamentals, right? And I think IT services was one of them. I do think some of the financials, to be fair, in the sell-off also look attractive at the moment, though.
Private banks?
The private banks, and you've seen that disparity really condensed. Now, HDFC had a little bit of drama, I would say, whether it's communications or miscommunications, but that had a role to play in it. And, you know, you're owning a solid deposit franchise at 1.7 times book. I think that looks attractive longer term.
So this drama is providing a good entry opportunity.
I think so. You know, I think there was the volatility that it created in the share price, whereas the banks started to kind of base out a little bit and pick up. And people were still about the merger, right? The ROE compression of that. And the ROA compression, I think that's headed in the right direction. It's got a fantastic deposit franchise.
So a few ideas where as you said, things are completely misaligned. Not misaligned, but completely misaligned, because that's where the sharper, in that sense, value lies. So there's HDFC Bank, as you said. In IT, it's Coforge and...
I keep them just because they've grown through this period of where the bigger companies have had a little bit more of a challenge in terms of growth. So I'd stick with those as the growth bucket.
Okay, what else, Conrad?
I would say the travel side, given the headlines in the news every day or every minute of the day, it's an ADR, but Make My Trip seems mispriced. Yes, they do have on the international side a fair bit coming from the Middle East, but now you're finally getting that stuff.
Anything in India listed names here?
Yeah, in India, I like the infrastructure, like GMR would be a nice solid
same aviation kind of GMR airports.
In that, Indigo too is a good franchise, and I'm not sure on the regulation side how that moves out. They've had their issues, and maybe they ran too tight. You've had the whole aircraft issues. You had the engine issues. So a lot of that stuff is getting behind you, right? If you ask me something, you're looking out longer term, and what's created an opportunity is, you know, the likes of Larsen & Toubro, a big Middle Eastern exposure, right? So that's an obvious one. Sell on the news. Once this is behind us, there's going to be a massive build that's going to happen. Those order books are going to explode. So if we pause short-term noise and think out longer term, those are attractive opportunities.
Have you rebalanced your portfolios, gotten out of stocks where there is a lot more uncertainty to enter into these names where you are seeing...
So Rima, like I said before, we probably don't change the portfolio as much, but I would say that in terms of dialing down the risk, I was just worried about the euphoria, and this was probably September, October of 2024. So a lot of the smaller mid-cap names, we just dialed back the exposure because you started to pay a growth premium, no liquidity discount. Now those have sold off significantly. So at some point it's going to look super attractive, but the larger caps are obvious ones in your face that, you know, I think makes a lot more sense.
And India was about 14% of your portfolio in terms of an allocation?
It has declined now when I think of it on a global basis. And I'll just take MSCI emerging markets. India has shot up to over 20-odd%.
Yeah.
A lot of folks who were long-term India bulls probably own significantly above that. I would say probably a third of their portfolio. That benchmark has shrunk dramatically. So we're down to about 10-odd points in MSCI. Our exposure would be somewhere in that vicinity.
10%.
10-odd% of the portfolio.
So you've dialed it down from the earlier levels.
So it's two factors. One is like I mentioned, we took down some of our smaller mid-cap exposure early on. Secondly, it's also the depreciation of both the rupee and the stocks, right? So in dollar terms, that has rebalanced down.
Final question before we let you go. March was an absolute horrific month from an India market perspective with the kind of selling that we saw from the FIIs, more than 110,000 crores in Indian rupees. Do you think with the rupee likely to hopefully stabilize at these levels, you know, the Nifty, if you look at it in dollar terms, is the cheapest in the last 5 years. If you look at it in gold terms, it's the cheapest ever. Would you think that the time is right for FIs actually to gradually start loading up India? We've gone through a period of underperformance, valuations relatively better.
I'd agree with that, Nigel, but I cannot pinpoint today what's an absolute catalyst or trigger for people to come right back in. So I do think that India needs to stand up historically with its own domestic engine starting to come through. And yeah, GDP growth is great, but domestic capex, right, has to really step in. Some of those, I think the EMS stuff was that, the China Plus One was nice marketing material. Right, but I think in absolute terms, you've got to start to see these EPS come through.
GDP growth is not looking all that great, right?
It is.
Just saw Moody's has brought I think real growth numbers for FY27 to 6%. And I think from one of the larger rating agencies, they're at the lower end of the range. I've seen numbers in the 5 handle. I mean, it is crazy.
So it is coming down, right? Globally, it's coming down. I think globally, you're looking at stagflation, right? Inflation's high. Now, may not be the worst thing on a nominal GDP growth basis if inflation is picking up. Now, that puts the RBI a little bit on a back foot. But if inflation is picking up while real growth is down, and you're still getting, call it 9% right? Plus on nominal, that's not a bad number for revenues.
Corporate earnings, yeah.
For corporate earnings, right?
Yeah.
So I think there's a little bit of a silver lining in that respect, Prashant.
Well, Conrad, we'll leave it there. Thank you very much. Great conversation, and thank you for dropping by.
Thank you for coming.
Thank you. Cheers.
All right, we'll take a quick commercial break here. We'll just run you through the interactions which are lined up here. 9 o'clock, we'll have Nitin Agarwal of Motilal Financial Services. And Conrad was talking about opportunities in the banking financial services space. So a bit of a deep dive with Nitin in terms of what he likes. 9:20. We have Amish Shah of BofA Global Research. We talk markets and what he's telling clients to do at this point. 9:35. Supreme Industries joins us on the full customs duty exemption on critical petrochemical products. And we'll get an industry perspective as well on that. Following that, we bring you a conversation on SEBI's consultation paper on reintroducing open market buyback of shares. So that's an interesting chat with Pranav Satya of EY and Bhavish of Equirus Capital. And towards the end of the program, Latha discusses the steps to basically push back against excessive rupee speculation. It's yielding results and whether it'll stay that way. Pranjul Bhandari and Mitul Kotech join her for that. That's later at 10:15. That's the lineup.
All right, time to slip into a quick break, but we've got plenty of stocks that we're going to be discussing post that break. For the time being, I give you a sneak peek into the top 10 segment. Axis Bank, HDFC Bank, Wipro, Bajaj Auto, Tata Motors, PV, Avenue Supermarts, L&T Finance and NMDC. They'll be reacting to positive news flow. Kotak Mahindra Bank will be reacting to negative news flow. We'll have a neutralish stance on Bajaj Finance. We'll explain all that to you on the other side of the short break.
Welcome back. You're watching Bazaar Morning Call. It's a Monday morning and we begin the earnings season with a lot of Q4 updates. So our entire research team is standing by. This is CNBC-TV18's list of top stocks for the day. First up, Ritu, I think there were more than 10, 15 updates that came through over the weekend, but let's run through the big ones. HDFC Bank, Axis Bank and Kotak Mahindra Bank.
Well, Reema, more than 20, I'd say maybe even more than 25, but who's keeping count at this point? The updates overall, though, are stronger than expected at a system level. Loan growth seems to be holding up. There is some pressure on deposits on individual banks, and LDRs, of course, are quite high. Now, within private banks, HDFC Bank, it can do with some good news, and some good news has come in. A clear green signal. We're going with green because business growth is above expectations. Advances are up 12% year-on-year, 4.1% quarter-on-quarter. Although keep in mind, this is a tad lower than the system-level loan growth that we've seen, which is closer to 14%, as per RBI's latest data from Friday. Now, the deposit growth was quite strong, more than 14% year-on-year, which is higher than the system. And the credit deposit ratio, and that's something the market will focus on, that is cooled off to about 95% from about 99% in the previous quarter. And CASA has also inched higher. Axis Bank also showing good momentum. Loan growth of more than 18% year-on-year, more than 6% quarter-on-quarter, well above the system average. Deposits up nearly 14%, steady improvement in CASA as well, and their CD ratio at just over 93%. But Kotak Mahindra Bank is a bit of a laggard compared to some of these. Loan growth and deposit growth are both below expectations. Net advances growth of about 16%, deposit growth of 15% overall, though, is strong, even though CASA is healthy on a sequential basis.
Thank you very much for that. Let me take it on to Wipro now. because Wipro has done an interesting deal. So for one, they have secured a multi-year strategic contract, which is worth $1 billion from Olam. Now, the total potential of the deal is $1 billion. What is committed from Olam is a minimum of $800 million, and this is spread over 8 years. But as a part of this deal, Wipro will also be acquiring Olam's IT, the captive IT services business, which is called Mindsprint. For that, Wipro will be paying $375 million, and this acquired IT company had revenues of $135 million as of last year. So basically, what Wipro is doing is that they're buying a long-term relationship, which is worth $1 billion, and they're using M&A to secure that long-term growth. So there are some positives of this deal. For one, you get a sticky contract, you get a sticky customer, you get guaranteed revenues of $800 million going up to $1 billion plus. Olam is big in the food and agri space, so it opens up that vertical. But on the other hand, generally, when you acquire a captive unit, you take on the employees. So in this case, Wipro will take on about 3,200 plus employees. Margins are typically on the lower side. So that is the risk. And the question really is that you're using M&A to acquire growth. So organic growth really could be a problem, which is why you're resorting to getting this deal and using M&A to get that contracted $800 million to $1 billion. So let's see how Wipro reacts in terms of performance today.
All right. Thanks a lot for that, Reema. Well, let's go across to Vinny, who's here to tell us about Bajaj Auto, Tata Motors PV, and Avenue Supermarts. Morning, Vinny.
Hi, good morning. So first up, in terms of Bajaj Auto, the sales numbers have come in largely in line with what one was expecting. Domestic as well as export growth have been more than 20% YOY. Overall exports healthy, but sales have slipped below 2 lakh units. So that's the only thing that's a bit of a blip there. Double-digit growth for 4 months is what one has seen in the domestic two-wheeler space as well. So overall growth for FY26 is expected to be decent. Fourth straight month that one is seeing 20+% growth for export of two-wheeler vehicles as well here. So mild green is what we're expecting. We have other than that, Tata Motors PV, that's going to be in focus as well. JLR has released their volume number for Q4 as well as FY26. Healthy volume growth number that has come in. Q4 volumes are up by 61% on a quarter-on-quarter basis. Year-on-year basis, we're seeing a decline of around 14%. Range Rover Sport and Defender form around 77% of their total revenue. Now, overall for Q4, the contribution continues to be at that versus Q4 FY25, it was at 66%. So we're seeing a growth versus last year in terms of contribution coming in from this as well. For the full year, there's an impact that one has seen here for US tariffs. China market has been a bit challenging. They've planned to wind down the legacy Jaguar models as well, and this is ahead of the new Jaguar launch that will come in. So these are some of the factors that have been impacting the company. But all in all, at least for Q4, the numbers are quite healthy. So green here as well. Demand, a good Q4 update that's coming from the company. Revenue growth of around 19%, 17,000 crores is what the revenue is coming at. Growth rate has been, quite good for this quarter, and in the last 2-3 years as well, it's done very well. The number of stores they've added, overall 85 stores now standing at FY26, and total stores are at 500. So they are continuing to expand the tier 2, tier 3 cities, which they've been talking about, and managing to see a good growth as well. So we'll see green here as well.
Thank you very much for that. Back to Ritu for Bajaj Finance and L&T Finance.
Well, Reema, it's a mixed bag for Bajaj Finance. The growth numbers are good, but deposit is where there's a bit of a negative. So AUM growth is in line with expectations and also within the management's guided range of around 20%. It has crossed the milestone of 5 lakh crores with a book over 22% growth year on year. New loan bookings are also strong, up more than 20%. And the customer franchise has expanded by about 4 million in the fourth quarter, although that's a tad lower than what the street was factoring in. The pressure, however, on the negative side, that's on the liabilities. The deposit growth, book has declined both year on year and sequentially, which is something we'll watch out for closely. So going with a mix for that. But L&T, on the other hand, that's a standout this quarter. Retail disbursements are up 62% year on year, driving a 39% growth for the full year. This was supported by expansion in rural, business finance, Pharma finance, SME book, all of that. And the retail book overall is up about 26%. And importantly, asset quality also seems stable with realizations improving to 98%.
Okay, all right. Thanks a lot for that, Ritu. Well, focusing on NMDC, they'd come up with the quarterly numbers last week, but over the weekend they went ahead and they increased prices. They normally give, the pricing on their Baila unit. Bailadila unit, that is. And out there, the revised prices come up for you on the screen. So the lumps are priced at around 5,300, while fines at around 4,500. What this means is the current hike with this particular new rates that have come out, the hike is close to around 450 on fines to around 500 rupees per ton on lumps. And the cumulative increase is quite large, between 600 and 700 rupees between early January till now. The quantum of the hike is a little bit surprising, and the street will be pleasantly surprised with that. There was expectations of a hike, but this quantum will be taken well. Well, let's do a quick recap then of all the top stocks we just discussed with you. We're looking at Axis Bank, HDFC Bank, Wipro, Bajaj Auto, Tata Motors, PV, Avenue Supermarts, L&T Finance and NMDC. They'll be reacting to positive news flow. Kotak Mahindra Bank will be the only one to react to negative news flow that could open up in the red, while we have a mixed view coming in on Bajaj Finance. That's about all the equity market action. Well, let's hop across to Manisha, who's here to tell us about what's going on in the commodities market. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, which are holding around that $110 a barrel mark. Well, U.S. has issued fresh ultimatum given a Tuesday 8 p.m. deadline as well, and has threatened to hit civilian infrastructure if Strait of Hormuz is not opened. In the meanwhile, what is keeping the prices in check perhaps is the OPEC Plus, which has approved a rise in output quota in their meeting in the month of April therein. But we do understand that most of the OPEC members are currently unable to export significant volumes. So it's a bit of a mix that we are getting to in sense of crude there. But the point being that we are making higher highs on chart. First, it was about holding $100 a barrel. Now it's about holding 110 on the higher side, with most banks and brokerages telling you that 120, 25 is what you could be looking at by the end of April, or if there are more attacks on energy facilities there. Well, that said, there is a bit of a profit-taking that we have seen in metals as a space, with U.S. threatening attacks on Iran power plants. There's post-liquidation yet again that we are seeing in markets here. So gold is slipped towards 4,600. It's down 12% since the West Asia conflict began, and silver is down 20% in the same period. So both trading in negative in Asia right now.
All right. Thanks very much, Manisha, for that. That's oil and gold in focus more later as we go forward. We'll take a break. We are back. We have Sandeep Agarwal of Sovelo Investment Managers. We'll talk about, of course, Wipro, the structure of the deal in terms of what that perhaps may mean for the stock, but of course also a quick run through of his view on IT stocks now. Stay tuned.
Welcome back. Let's invite Sandeep Agarwal, fund manager at Sovelo Investment Managers, on the show now to talk about Wipro, to talk about the IT sector ahead of earnings. So Sandeep, let's begin with Wipro. Now, Wipro seems to be using M&A to buy growth. So they've struck this $1 billion deal with Olam. But it comes with Wipro having to buy Olam's captive IT unit called Mindsprint for $375 million. And if you just look at the way the deal is structured, so Mindsprint's revenues were $135 million as of last year. The contract runs for 8 years, which means $135 million into 8 years is $1 billion, which is what the deal is about, a $1 billion deal. So there's no revenue outside of what they're paying per se for the acquisition. What have you made of this particular transaction, and what do you think? There is revenues, but what would it mean for Wipro's margins?
Hi, good morning, Rima. So I generally avoid commenting on company, but since we don't have this in our portfolio, nor we recommend. But let me put it this way, as a tech expert, that, if you take 15-17% IT services margin where, Wipro has been operating, then it means 175 million in the next 10 years, right? So basically they are paying $200 million, and this is not a NAV, right? Because you have to discount it. So then, it boils down to the fact that you are paying around almost 250 million or something like that for getting either entry into the markets, entry into the clients, or entry into the FMCG and agro clients globally. So that is what you are paying for. Now, I don't know Wipro itself has such a strong capability in consumer side, whether they really need to go for the capabilities. So it looks more like, multiple factors, including that, to get a large deal and also to get some of the clients which they may not have. or maybe some of the geographies, the Middle Eastern market or some other geography. Because if you see, Olam operates mostly in Singapore and Middle East. So maybe because of that reason. Otherwise,
These
on
are bad
pure
deals.
commercial, yeah. No, so I would not comment bad or good, but I would say that I don't know real rationale behind it, because on one side you are taking, means you are paying 375 million. Even if you make 15-17% margin, it is very tough to find out what all benefits you will get. But let me put it this way, that if you see the global talent chart and the cost of execution chart, you will see that after India, the highest amount of tech resources in the world at lowest price are available in Singapore. So that is the second country with which we closely compete, and their prices and their cost is almost 7-8 times of us. So in that sense, maybe the second best option of acquisition was in that geography, and maybe they would have gone ahead and done with that purpose. Generally, most of the IT companies, when they acquire in Europe and others, there is a loss at the EBIT level. We don't know whether there will be loss or profit, but that is what my understanding is. I would not put it as a great deal or a bad deal because of insufficient evidence or data. But yes, this is what it is. It is a cost takeout kind of deal.
But is it signaling that organic revenues and growth is difficult to come by, which is why we need to get these $1 billion deals, but it's attached to conditions by the M&A arm? Use M&A to buy the captive IT arm.
So, Rima, if you see the financials of Wipro, for example, last few years, they have not been able to grow much. That is a fact. They have, in fact, not grown well in last 12-15 years, except barring 1 or 2 year or quarters. So from that perspective, they don't have a choice. But so right now, the isocont which they are doing is that the money which they keep as cash, what they make on that, and versus that, if there is a higher ROI on an acquisition along with strategic benefits, maybe that is the way they are evaluating, and that is the way most of the Indian IT companies are doing. So if you would have seen that a large tech company, one of the largest one, announced data center, and that business, again, the rationale there will also be that the margins and the ROI in that will be much more superior to the benefits which they are getting by keeping that money in bank. So that is the way now things are happening. That is a mature business cycle, and that remains like that.
Okay, now let's get to the IT view. Sandeep, because you were very bearish in IT through 2024, 2025, and now you've turned extremely bullish on the IT sector. Take us through. What's changed?
So, Rima, the simple change which has happened is that, 1.5 years back, the stocks were at 5-6 times PEG ratio. You take the large cap, you take the mid cap or small cap. That was insane in my view. Now, what has happened? One, the index has corrected 40%, which was in line with my expectation 14-15 months back. And the stocks, some of them have corrected even more than that. So that slashes down your PEG ratio, let's say from 6 times to 3 times. Now, add on that, 1.5 years, they have made some money, right? So that if you do that mathematics, they are at 2.25 times PEG ratio. And now with rupee depreciating almost 13% in last 1.5 months, we are talking about 1.2, 1.3 times PEG ratio. So just for your information, the earnings of most of the tech company will at least grow by 15% to 25% depending on the margins of the company, only because of rupee depreciation, which I don't think people are taking into account now. So if you are going to get, let's say, a CAGR of next 2 years earnings of even 15-17%, then the multiple are 13-15 times. There is no case for being bearish on this. And see, I don't believe that AI will take away the IT services piece and all that. I think there is a 20% reduction in effort spread over 5 years. So you have a 4% deflation annually, and you make 5, 6, 7% new business, you are home. And I think we are in that situation. So paying a 1.5, 1.2 times PEG ratio versus 6 times is a very good correction in my view. While stock may look at 50% correction, actually the multiples have corrected, the PEG ratio is corrected by 75-80%. So it makes a strong case for all the tech companies. I will not name out anyone. Only caution which I will say is that I will not buy still the ER&D companies. I will buy ER&D companies after 6 to 8 quarters of, once that Ukraine and Russia war gets over. After that, 5-6 quarters later, I will start buying ER&D company, not now. But other than ER&D, whole IT service space, I love the space. Now with the correction, I think that there is a good money to be made. Again, this is not a sector which is structural in nature.
Yeah. Sandeep, hi. Morning. Prashant here. So just to wrap up, so you're saying The last point is important. Sometimes valuations get attractive and then they can remain attractive for a long time. So you kind of sort of buy in and then you wait and hold on and it's dead money for a long time. This is not that case. You're saying there are triggers and these earnings will come through which markets are not anticipating, and hence over the next 1 year you will make good money. That's what you're saying. So if you have 100 rupees to put in, where would you put it in? I mean, and the thing is, you're not just focused on, you track IT, but you look at everything. So and in markets, opportunity is all relative, right? So IT would be top of the list. So how would you allocate it, Sandeep?
So Prashant, very good question. So let me put it this way. This is a trading sector with a 5-6% growth for large cap and 8-9% for mid cap for next 5, 7, 10 years. And you add rupee depreciation benefit, whatever it is. So I think that now is the time when, because of rupee depreciation, suddenly 13-14% return additional. And last 2 years, there has been no return. So I think broadly 30-35% kind of return in the sector can be made from here. If it happens in 2 years, it will be 15% annual return. If it happens in 1 year, it is 30% in 1 year. If it happens 6 months, great. So I don't know in what duration it will happen. Generally, I have seen that, mispricing get corrected very, very quickly. So I was almost zero weight in IT in our PMS for last 15-16 months. I think now the time has come where I will go at least equal weight, whatever is the weight of the index in the of IT in the index, or maybe 1-2% overweight. That is the way I am looking at it.
Okay, all right. Thank you very much. Good speaking with you, Sandeep, and always useful to talk about the IT space, and of course also about how to approach things. And once this Iran thing fades away, we can maybe we were having all those conversations around AI, and Sandeep is a keen watcher of everything AI and impact on IT software companies and elsewhere. So we'll sort of get him back on more regularly. Thank you. Well, Dharmesh Kant is with us, Head of Research at Chola Securities. Dharmesh, good to have you with us here. Okay, Nanji, you want to take that? Sorry, my mic is...
Okay, all right. Let's get in Dharmesh Kant on the show. Hi, Dharmesh. Good to see you in Monday morning. We've got a lot of quarterly updates that have come in. Avenue Supermarts, that's a stock actually that's seen as a fair bit of correction from the top. Valuations had gone through the roof. Now it's cooled off a little bit. And there are signs of green shoots. Are you interested in the stock at these levels?
Yeah, good morning, Nigel. I mean, yeah, incrementally the numbers have come better for Avenue Supermarts, but the valuations are still, if not through the roof, it's near the roof as of now. So I think tactical bounces can still happen with most of the retailers. Even V-Mart Retail came out with a very good set of numbers. And so there can be some tactical play, setting in, but I don't think it's a structural, again, story in the making. So just on the basis of valuation multiples, we are not comfortable with holding it for a long period of time. Maybe for, 10 or 8% kind of a gain, one can enter into as a tactical play. Our own sense is going forward, this entire space will settle down around 15 to 17% kind of growth rate, but that too will come through only when you have a new store addition. Same store sales growth it's hard to get 10-11% kind of a growth on a annualized basis for a long-term basis. So that's the reason why we have been avoiding this space.
Got that. So Avenue Supermarts is an avoid. Dharmesh, in the banking space, Innocent Bank is a stock that you like. It's work in progress. It's a potential turnaround candidate. But we have a lot of other banking updates that came out. For Chola Securities, is there any banking update that stood out for you, which is now, therefore, the bank is on your watch list?
Yeah, good morning, Riba. I mean, most of the banks came out with a stellar set of updates for Q4. So advances growth were on an average in line with 14 to 16% kind of an advances growth. Deposit growth incrementally has picked up. There's been an advancement in the deposit growth. However, different banks have different set of inter-deposit growth. The CASA ratio for some banks have not grown that fast as opposed to the time deposit growth. So time deposit are a bit expensive than the CASA ratio. So ideally, the CASA should be better out there. So, we liked Kotak Bank update quite a bit, though, advances go to 16.5%. This was again in continuity with Q3, a good set of growth numbers. And the CASA base grew far better than if you compare that with, say, HDFC Bank. So HDFC Bank CASA grew by 12.5%, whereas Kotak reported around 15% kind of a CASA growth, which will help them in getting a better yields. So, but what we are concerned about banks as of now is not Q4 numbers. There would be definitely a good set of numbers. But how the treasury book plays out and how much of that is priced in Q4 numbers, how much they do it, how much goes into Q1 and Q2 FY27, and what's the commentary on the entire, credit cost space with regard to MSME and SME segment. So but that's what will keep a lid to strong price traction in banking space. So we are watching it, but fundamentally from a long-term perspective, we are holders in IndusInd Bank, followed by Axis Bank from the private banking space and Bank of India and Bank of Baroda in the public sector banking space.
All right, we have spoken a lot about tech since morning. Dharmesh, how are you positioned over there? We had Conrad Saldana who joined us earlier, and he was saying that maybe, in fact, risk reward is fairly okay from here on. Even Sandeep, if you heard the conversation Rima was having earlier, he's been negative on the tech pack and he's turning relatively positive. Do you think the worst is in the price? In the last 1 month, by the way, the index has outperformed the Nifty.
Yeah, I mean, everything has a value at a particular price. And I think tactically, tech does look to be a tactical play rather than a strategic play to my mind. I think most of the deal wins which I have noticed, it's more of a replacement kind of a deal win to keep the revenue flow intact. So if you're expecting a degrowth in the revenue going forward, so maybe that gets arrested with tie-ups happening with most of, I mean, all the companies have done AI player tie-ups. So we would be watching very closely about the commentaries. However, as far as management commentaries are concerned, they have been, quite stable to bullish kind of scenario. They have been painting, but numbers are not, matching up to the same level. Our own senses, even I heard the conversation, 2.5 peg ratio is expensive for, a sector which is likely to grow mid-single digit, and a lot of, confusion and uncertainty still prevailing as regards to how much margin dilution will AI bring into play. So there's already a third party into play for AI products to be rolled out. So that is our sense on the tech space. So largely we are watching on the sidelines. Tactical play can be Infosys or TCS. One can go long on. However, with one exception of Orion Pro Solutions Limited, which we have an initiative coverage, we are holding on to that company as a buy rating till now.
So Dharmesh, the argument that Sandeep was making is that while the top line growth may be, say, mid-single digits for large cap IT companies, the EPS growth is going to be 15-16% purely on account of the rupee depreciation. And then EPS growth is not getting, adequately captured by consensus expectations. That, coupled with the fact that valuations have come down post the correction, makes the IT sector attractive for a tactical buy. So the revenue may be muted, but the EPS growth will be quite solid. So would you look to go tactically long on any stock, or it's still not compelling enough, the argument?
Yeah, precisely. I mean, that was my precise point as well. It's a tactical play. And see, we buy a business for the business growth and not for because of some currency tailwind playing out. So but that's the only, problem area or a gray area which needs to be addressed to our mind. And currency tailwind will play out. So for tactical purpose, as I just mentioned, TCS Infosys, one can stick to for tactical purposes. Mid and small cap will give you a better alpha, but it's dangerous. I mean, if something goes wrong, some other, AI development comes through, and the rub-off can be far, severe than the run-up to the stock price. So, the ideal advice would be to keep your stop losses in place. They are already floating at bottom levels. No new selling is coming in from the fund side or, large groups, which we have noticed. So that's a positive trigger. Tactically, yes, definitely. One can play it out. Infosys TCS from the large cap space.
Dharmesh, do stay on. We need to slip into a very short break. For this quarter itself, in Q4, the rupee has depreciated by 2.5-3% on an average against the dollar. And point to point, that's 31st March to 31st December closing, the rupee has fallen by nearly 5.5%. So Q4 will also see the benefit of rupee depreciation. Get into a break. On the other side, we'll continue chatting with Dharmesh. We'll also focus on some volume buzzers. We'll connect with Mitesh Thakkar and Sudarshan Sakhani for some technical trading ideas.
Okay, welcome back. We've got the big movers from last Thursday, volume and price-wise. Hormuz is here with that list. To refresh our memory, Hormuz, take it away.
Good morning, Prashant. And some underperforming names to start off first. Pine Labs is one such name. It was among the top shares on the delivery front on Thursday. It has declined in 7 out of the last 10 trading sessions over the last 10 sessions. One of the underperformers in Thursday's session as well. And the Friday's volumes, though, were double of Thursday, but continues to remain below what was the daily average over the last few trading sessions. 15 lakh shares were traded. The 20-day average is around 11 lakh shares. The delivery percentage was the highest in the last 2 months. 80% of those shares were marked for delivery. 12 lakh shares for delivery, 20-day average of 5.2 lakh shares. And from its IPO price of 242, the stock has corrected almost 40% from those levels as Pine Labs. Now, LG Electronics has been another underperforming stock over the last 3 sessions. It was the 3rd straight day of losses for the stock. It has declined 15% during this period. The 6th straight day of volumes in a single session being above 10 lakh shares for LG. 18 lakh shares were traded, 20-day average of close to 8 lakh shares. 56% of those were marked for delivery. So around 10 lakh shares, the 20-day average on the delivery front is around 4.5 lakh. And the stock is down 23% from its listing price, which was over 1,700 rupees, but continues to sustain just above its IPO price, which is close to 1140. And lastly, an outperforming name in the recent past, Page Industries. Now, this was 2nd straight day of gains. 4 out of the last 6 sessions, the stock has done well. Up 9% in the last 6 sessions. The volumes on Thursday were the highest in over a month. The volumes are close to 80,000 shares traded, 20-day average of 22,000 shares. The delivery volumes, though, were the lowest in almost close to 2 months. There are only 21,000 shares were marked for delivery, the 20-day average of around 10,500 shares. And the stock from its 52-week high, which is well over 50,000 rupees, is down by a third, almost 33%.
Okay, all right, Hormuz, thanks a lot for that. Well, we're still in conversation with Dharmesh Kant. Dharmesh, I recall you making that call, I think, on Hero MotoCorp, if I remember correctly, a few months ago. And then I think you had advised booking some profits as well when that stock had moved up. How are you viewing the auto sales numbers and what's the pick of the pack from there?
Yeah, thank you so much, Nigel, for that. I mean, definitely the auto sales numbers were very stable and a lower set of numbers which came through for Q4. Almost all the companies reported a good set of numbers. Hero MotoCorp stands out again, 20% plus kind of growth numbers. Almost 6 lakh units sold put together. So 5 lakh run rate for the year on a monthly basis has been attained by Hero MotoCorp. Price has corrected quite significantly. I think at 18 times on a trailing basis. Price to earnings multiple is quite attractive as compared to, I may say, a Bajaj Auto, which also delivered good set of numbers. But to my mind, the valuations of Bajaj Auto is a tad higher than that of Hero MotoCorp. At the same time, if you look at other numbers like TVS Motor, the numbers are good, but again, the valuations are a bit expensive. Eicher Motors was a muted kind of a number. So the top pecking, in the pecking of the top, buy remains Hero MotoCorp. We are again, recommended it for again structural play in the making into the monsoon season and wedding season going on. So Hero MotoCorp from the two-wheeler space, four-wheeler space, M&M looks pretty attractive. And again, a very good time to re-enter into that company. 23% kind of a run rate is likely to be maintained for going forward on the sales, both farm equipment and the passenger vehicle space, followed by Maruti. So these are the top 3 picks from the entire automobile space. We have again reinitiated buy on all 3 of them.
Okay, Dharmesh, we'll leave it there. Thank you very much for joining us with that. There's 4 minutes to go for the pre-open session to kick off. We'll take a quick commercial break here. We'll come back. We have Nitin Agarwal of Motilal Oswal Financial Services to talk about the banking update. By the way, there was a banking update coming in on Yes Bank just 5 minutes back. So, we'll address that along with the other stuff with Nitin. Stay tuned.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, it's that time of the show when we get, our tech analysts back on the show. Midesh Thakkar as well as Sudarshan Sakani join us on the show. Good morning, gentlemen, and good to see you all in. Well, Sudarshan, let me come across to you first. You know, on Thursday morning, you made this bold call. It's time to show guts. Go in there, buy the Nifty, and you'll make some money. Well, congratulations on that call, because it didn't seem very, very rational to go and buy the Nifty on Thursday morning. But you made good 500 points if you got the bottom. And if you bought it during the course of the day as well, it was pretty good. What's your call now? We ended with some gains. For this morning, we're like to start off 100 points lower thereabouts. Buy the dip?
Yeah, good morning. Thanks, Nigel. No, it's not buy the dip today. See, we need a large dip to buy. 100 points is not a dip. It's a small correction after that big move. So the buy the dip trade still exists, but we need very big dips like the ones we got, and we'll get it again. You know, when the markets start building a base, there is a lot of uncertainty. In that uncertainty, there are many days when the markets say, okay, I'm going down 200, 300, 400 points. Those are days when we want to show courage. Today, the markets are likely to be choppy. If you still have long positions, take profits and step aside. I don't think there is a very reasonable trade today. Just watch it.
Wait and watch on the Nifty. Mitesh, what would you go with?
Oh, good morning. So I think, there is some sign of a first, sign of market trying to at least find a base. If you look at the Nifty chart for the last about 8-9 days, around this 22,300, 22,200, and while there have been intraday declines below that, the 2-3 hour charts have got multiple closing in this zone. So I think I would watch for this level of 22,250 thereabouts very closely. To me, I think that's becoming a small fulcrum. And as Sudarshan also rightly said, in case we have a big dip, we are closer to about 22,250. Which is around, if you're at about 22,400 or thereabouts, you have a 150 point kind of risk. I think that's the time when I would want to start getting into some kind of a long bias positions. I think we have had a good decline. Now, most of the indicators are trying to reverse on the hourly charts from extreme oversold levels. In that reversal, if you get a dip, and then, the rebound will be very fast. So the idea is that on the Nifty, I think wait and watch. But if you get a slightly bigger dip, I would also be on the buying side.
By the way, the rupee started 93 compared to 93.10, which was Thursday's close. The big recovery, the 2% recovery, of course, by the end of it was the dollar rupee. The rupee strengthening after additional measures from the Reserve Bank of India came through this morning. The gains are being held, and this is a much stronger and steadier kind of rate up on your screen. Gentlemen, morning. Sudarshan, what would your trades be?
Well, it's Vedant, which is a buy with a stop under 675. Marico is a buy. Actually, other FMCG stocks are also opportunities. I just selected Marico. It's a buy with a stop under 745. Laurus Labs is a buy with a stop under 1025. And Concor is a short with a stop above 445. But apart from avoiding the Nifty, it may be worthwhile looking at stocks individually.
Okay. And Mitesh, what about you?
I have a buy on Kalyan Jewellers. I think, it's one stock which did not make a fresh low in the last 7 days as Nifty did, and is on the verge of a reversal. The first pivot is around 396, 397, and the stock closed at 394. So buy about 397, keep a stop at 389 for targets of 411 to 415. Then I also have a buy on Aurobindo Pharma with a stop at about 1309 for targets of 1380. Sell on Biocon if you get the stock around 356, 357. Sell with a stop at 363.5. Look at targets of 340. And the final buy call is Cochin Shipyard. Buy with a stop at 1286 for targets of 1365.
I'm glad you mentioned Oro and maybe Pharma as a pack, because I think that clarification, if we can have the Pharma index, Oro, of course, saw that big recovery from the day's low, but I think so did more stocks, because the market recovered as a whole. But Oro, Cipla, Lupin, Sun maybe to a lesser degree, but I mean other names as well. Maybe the news was, the fear rather was that tariffs from the US on pharma, right, on patented products, whether it'll have an impact on Indian companies, etc. And that clarity started to come through early on in the morning. Well, this was not about generics and Indian and mostly Indian exports to the US are largely generic. This is for patented drugs, and there are lots of exemptions. So we'll see if this shows up. Aurobindo, of course, also has a buyback, which they have announced, and the details of which we were carrying a little earlier. So
buyback is what Aurobindo has approved at a price of 1475. So that's the two important details. 800 crore and 1475 is the price.
All right. Well, I think more on this with that buyback discussion coming up a little later. But Sudarshan and Mitesh, thank you very much, both of you, for joining us with that. With those specific trades right now. Well, let's just go back to banking and let's quickly revisit the top numbers that you need to pay attention to. This is the updates for the quarter which came through. Ritu is here with a quick run through. Ritu, take it away.
Well, Prashant, it's a seasonally strong quarter, typically fourth quarter. But that said, the loan growth has actually been above estimates for most banks. And even deposits growth is not too poor. There are a few misses here and there. But at a system level, it seems growth is holding up. LDR, of course, remains elevated, because credit growth is still outpacing deposit growth. Now, within private banks, HDFC Bank stands out. Clear green signal, business growth has beaten expectations. Advances are up 12% year-on-year and about 4% quarter-on-quarter. But keep in mind, this is a tad lower than the system-level growth that we're seeing. And as per RBI's latest data, the system-level loan growth is about 14%, so it's a bit below that. The deposit growth is also quite strong, more than 14% year-on-year, which is higher than the system. And most importantly, the credit deposit ratio for HDFC Bank is cooled off to 95%. So the street will take that positively. For Axis Bank, for instance, there is solid momentum as well. Loan growth of more than 18% year-on-year, 6% quarter-on-quarter, well above the system average. Deposits growing by nearly 14% year-on-year and a steady improvement in CASA. The CD ratio at just over 93%. Kotak Mahindra Bank, loan and deposit growth, net advances growth of about 16%, deposit growth of nearly 15% year-on-year, CASA growth healthy on a sequential basis as well. So overall, it's looking good for the banks with a few exceptions here and there, like IndusInd Bank, for instance, which has seen a degrowth in the quarter.
Thank you very much for that, Ritu. And looks like some of these banks may support the markets today. So that GIFT Nifty was suggesting a downtick of 100 points at the start, then it came down to 90 points, then 50. But in the pre-open, it's absolutely flat, but with the positive buys. The Nifty's up 65 points. Sensex seems to have settled with a gain of 160 odd points. Nitin Agarwal, Senior Group Vice President and Head of BFSI Institutional Equities and Motilal Oswal Financial Services, is now joining in. Nitin, great to have you on the show today. Let's begin with your opening thoughts on the Q4 update. And then tell us 2-3 banking stocks that stand out on the positive side and negative side.
Yeah, hi, thanks for having me. So several updates have come on the bank side, and most of them are on the positive side, and many of them have gone on to beat our estimate for the quarter. While we definitely had an idea already that the loan growth will likely be strong as reflected in the system numbers from the RBI, but many banks have gone on to report a high single-digit loan growth on a sequential basis this quarter. And within that, even the larger banks, if you look at the HDFC Bank reporting a pretty stellar kind of a deposit growth, and even Axis, which reported, again, it has been doing well as given that their guidance to beat the system growth by 3% over a 3-year basis. But the bank has done quite well over this year, and therefore it's pretty much on the right track. And amongst mid-sized banks, RBL clearly stands out with a double-digit growth that they've reported on the business front, and kind of a precursor to how the growth numbers can change once the deal concludes. And the other bank that stands out clearly is AU Bank, which has also reported a very strong business growth both on advances and deposit side.
Okay, so RBL and AU Small Finance Bank on the mid-cap banking side. Any misses?
I will say that IndusInd, which has been reporting a slight decline quarter to quarter, that trend has continued, and probably it's in the last leg of that, as the focus remains on cleaning up the balance sheet and improving the net NPA ratios. And hopefully things will start to turn the corner from FY27, but this quarter there is again a marginal decline that the bank has reported. So it's more like a flattish, I will say. And the other is like IDFC, wherein the Q on Q with the deposits have been broadly flat, given the recent developments.
Yeah. Nitin, good morning, Prashant here. We had Jairam of Piramal with us on Thursday, and he was basically making the point that, when there is a shock, it's not as if people immediately stop paying, right? That comes a little later. And he said this will, whatever is happening, and we don't know how long this will last, and that's the critical question, how long this will last. The longer it lasts, I guess there is more pain across the board. But he said, well, expect all of this to show up in the second quarter. He said July, August is when he would expect some spike in NPAs in those segments. He said it's small. It's not very large at this point. These are smaller segments, MSMEs, etc. Any thoughts on this, Nitin?
No, I agree to that point. And while going into the preview, we have just cut numbers by around 2% for PSU banks and marginally 1% for private banks. And that is a reflection on how the bond yields have gone up, how the deposit rates have not been able to come down to the extent that one was looking at 3 months back. And now the wholesale deposit rates, the CD rates, they've all gone up quite considerably. So all of that will have a bearing on the margin expansion that we were earlier looking forward to. So which is where we have toned down our numbers, but we have mentioned that the risk to the earnings is more on the downside. Going into Q4, most banks have indicated a pretty steady asset quality, and our numbers therefore reflect continued strength on that front. But yes, if this crisis, the geopolitical situation which is going on, remains like this for another month or so, then yes, there is a implication that it will have on both the loan growth and the asset quality. And you will see cut, yes.
Yeah, he also said that the first 10 weeks, and we've heard this from others as well, he said, he said we don't know what changed, but the first 10 weeks of this year were incredibly strong in terms of loan growth and disbursements, etc. And then, of course, I mean, this entire thing only started about a month ago, late February, right? 27th, 28th of February. So, I mean, even you think this credit cycle was looking like it was starting to pick up. That gets punctured a little bit, Nitin?
That's a possibility, yes. So far, for this year, we are looking at a 13.5 to maybe range about 14% kind of credit growth for this year. And our estimate is that the growth will sustain at 14% CAGR over the next 2 years. But if we see this scenario playing out with the resultant impact of elevated crude prices, some problems around the supply of the gas availability and businesses seeing some interruptions, there will be an impact on the overall system growth, because this pickup in credit growth so far is pretty broad-based. It's just not any one segment driving it. It's like the retail, industry, services, all the segments are going at a healthy run rate and then seeing some pull-up. And so there will be some moderation, and the overall GDP growth also may see some cuts if the scenario goes on for another month or so. So there is a risk that we see clearly that is there on the downside.
Nitin, do you look at Bajaj Finance? The AUM growth of 22% is in line with their guidance for the full year. But deposits are down 4%, so clearly facing some pressure on deposit mobilization.
I think deposits has been a challenging area, not for the entire system, I will say. And most banks are finding it difficult to raise deposits given how the overall credit momentum has been. And Bajaj Finance, in particular, I think might have deprioritized raising that much of deposits because the yields, the deposit rates have hardened quite significantly. The wholesale deposit rates, the CD rates have gone up very sharply in the last few months, and there is a possibility, therefore, that the company might have deprioritized raising deposits, especially in this quarter.
Have you had a chat with some of these smaller banks or NBFCs on account of the stress that's building up in the MSME sector? It may not be pronounced in the Q4 numbers, but it will show up at some point. Credit costs, maybe banks are turning cautious on lending to MSMEs. What has been your takeaway, the feedback on this issue?
I think investors are watching out the composition of SMEs across lenders, and therefore to make a sense as to where the vulnerability is more. We have historically seen that in any macro shock, SME, MSME are the segments which get interrupted firstly, and they have limited resilience to showcase. And which is where there might be asset quality implications if this crisis goes on. But for now, till maybe where we are till now, it is still manageable. It may have an impact on your profitability or the revenues, but not as much on the asset quality side. But if this goes on for another few weeks, I think then this will have a bearing on both the loan growth and asset quality. That's what most lenders have indicated to us also.
Okay, all right, Nitin, a good chat. Thank you very much, and hope you come back after the numbers in the fourth quarter as far as BFSI is concerned. Well, 9:10 calls. It's actually 9:13. 2 minutes to market open. Sudarshan, what do you have?
Marico. Buy Marico with a stop under 745.
Okay, Marico, and Sudarshan doesn't likes Marico, but he likes other FMCG as well. But that's a call. Marico from Sudarshan. Mitesh, what about you?
Yeah, I'll go with the buy on Kalyan Jewellers.
Kalyan Jewellers, got it. Well, let's just quickly run through Aurobindo. There's that buyback which has been approved. Ekta is here with the details. Ekta.
Thanks for that. Well, yes, Aurobindo has approved a buyback. It is up to 800 crores. The buyback price is 1,475 odd rupees and will be via a tender offer. The record date is 17th April. They will begin the buyback on the 22nd of April and they expect to complete it by month end. Remember that Aurobindo had completed a buyback worth around 600 crores around 2 years ago. And separately, the company has around 200 million plus dollars in terms of cash on books. Now, the Lanet acquisition, which is basically something that the street is watching out for, which is in the US, is expected to be completed in the next 2 weeks. So the street will be watching out for that trigger in particular.
All right. Let's just run through market open, Ekta. Thank you very much for that. Oro stock will come up as well. The Nifty is starting absolutely flat. It's about 10.5 point change, 22,700. The sensex is coming up as well. It's kind of flattish as well, blinking red and green. Small cap index is flat. Mid cap index will come up on your screens in just a bit. So 1,140 stocks are higher, 760 stocks are lower. And we are, I mean, in a way, in no man's land, neither here nor there. But of course, from the lows on Thursday, we were able to sort of latch on and hold on to those gains. Trend, Wipro, Power Grid, that's the Nifty heat map, are the top three gainers. Kotak, Sun and Adani are the top three losers at this point in time. So, I mean, it's a, disinterested kind of open, 10 point, 11 point, sideways kind of start. But I guess there'll be more action as far as single stocks go with all those fourth quarter updates from companies coming through. Rima.
Well, Trend is your top gainer, so that straight away opened up with a gain of about 3% after the company reported a 20% jump in their Q4 revenues as per the business update. So that's driving the stock higher. Other consumption names like Avenue Supermarts, again, the business update with a 19% top-line growth was better than expectation, higher than their run rate over the last couple of quarters, so stock has opened up in the green. Wipro is reacting positively to the deal with Olam, a $1 billion deal. And for which the company will be acquiring Mindsprint for $375 million. So Wipro has secured its top line and that's helping the company, the stock, move up by nearly 2%. But generally, there is green on the screen when it comes to IT. So Infosys, TCS, HCL Tech also up between 0.5% to 1%. Tech Mahindra is quickly moving up to the leaderboard chart. Power Grid is another stock that deserves mention. That's opened up strong. Aurobindo Pharma, Ekta was just talking about the buyback, 800 crore update. The stock has opened up mildly in the green. Bajaj Auto, where the March sales growth has come in at 20%. That looks good. So that's helping the stock open up in the green. But on the flip side, Tata Motors passenger vehicle has been impacted this year on account of the war, the China issues, the cybersecurity, etc. Tata Motors passenger vehicle stock has opened up in the red. On the way down, you've got Interglobe Aviation weak in trade, Kotak Mahindra Bank, where the business update was lower than expectations. Tata Steel, Sun Pharma, Eternal, Ciplas, Dr. Reddy's. Actually, quite a few pharma names are on the back foot today.
Well, that's right, Rima. A few stocks that deserve special mention. You have Senco Gold. The Q4 update came in there. Revenue growth of around 46%. Same-store sales growth at around 34%. That stock is bursting away in trade, up close to around 7%. So good green out there. Another stock that's reacting positively is Vikran. Vikran, I think they had an order win that they had announced. So I think the street likes that. That stock as well has opened up well in the green in today's trading session. You have GR Infra, that's the other stock. Vikran Engineering, they have received an LOA of around 530 crores from MSE DCL for power distribution work. GR Infra, they have signed an EPC agreement worth around 1,900 crores with the Central Railway. So that stock as well up and about. We're down close to around 100 points on the Nifty. Individual stocks doing a thing of their own. For the time being, the number of stocks declining are in the ratio of 2 stocks declining for every 1 stock that's advancing.
The top loser, Nigel, is Chennai. The biggest volume-led loser is Chennai Petro at about 990. So, there are news articles this morning saying that oil companies are capping refinery payouts to refineries because input prices have surged, refinery spreads are very, very high. I mean, and so on and so forth. We've seen action there with regards to limited price pass-through for things like jet fuel, ATF, etc. So refineries are under pressure. Defense all went up sharply last week. Garden Reach and Mazgaon are lower. Indigo is down about 2%, so 41.12 or so. Loris is down 2. Hyundai is down 3. Indusin is down 1.75%. Cochin Shipyard. So yeah, I mean, some of these shipbuilders, which all went up like rockets last week. BDL is another one. So defense generally taking a bit of a step back. Voltas has had it tough. 2.25% lower on Voltas, 1,200 or so. Blue Star is down another 2%. But I think Blue Star was down last week as well, by about 5-6%. Glenmark is another one which is down about 2% or so. 2:1 down, what is down to what is up at this stage. Well, Amish Shah is with us, Head of India Research at BofA Global Research. Amish, great to have you back in the program. Thanks very much for joining us. Appreciate it. Prashant this side. So lay it out for us in terms of how you've changed your earnings estimates, Amish. And that seems to be a moving target with all the headlines which seem to be constantly moving around. And then what is the view on markets themselves, Amish?
Sure. Morning, Prashant. So look, I think from an earnings perspective, stagflation risks are now real. If I look at the macro, we are already forecasting that the GDP growth will come down from 7.4 that we were estimating earlier to 6.5. Similarly, fiscal deficit is going to go up, inflation is going to go up. We are already forecasting for a 50 basis points interest rate hike this fiscal. Similarly, on the commodity side, we are now working with $92.5 per barrel of crude for the year as a whole on an average, $100 for the remainder of this year. So when we incorporate all of these things in, we do think that there is one more round of earnings cuts that we had to incorporate. So the conflict started in the end of February. On the 2nd of March itself, we had brought down our earnings growth from 14 earlier to 11, and now we are taking it down from 11 to 8.5.
Okay. And where are the biggest earnings downgrades coming through? From 14 to 11 and now from 11 to 8.5%?
So, Rima, most impact is for rate sensitives because if we are pricing in for 50 basis points of interest rate hikes, then NBFCs, real estate, REITs, passenger vehicles, everything that's rate sensitive gets impacted. And obviously, if you are working with a higher crude, then downstream energy and the consumers of crude and crude products, those are the ones that get impacted the most.
Yeah, got that. By the way, how much of all of this, Amish, is on that assumption, that basic assumption that oil stays at 100 for the rest of the year, Amish? I mean, say, for example, if oil were to come off, say it's not 100, but say, 80. Will everything change? All these assumptions change dramatically?
Absolutely, Prashant. Because crude, as we know, feeds into fiscal deficit, current account deficit. As a result, has an impact on growth, inflation, rates, all sorts of assumptions. So if the crude indeed were to come down lower, we would look to, there would be a reason to upgrade our numbers. But as of now, we do think that even if the conflict ends, given the damage to the energy infrastructure already, crude will stay higher for longer. That's our base case commodities view right now.
So give us the market view then. Amish, where are we? Are we in a bit of a no man's land with all of this?
So Prashant, I would say that what we also did is look at the last 15 years. Indian markets have seen a total of 6 crises over the last 15 years. Iran conflict that we are going through right now is the 7th such crisis. So by crisis, I mean that any event in the world that has impacted Indian markets, so it was Eurozone crisis in 2011, 2012, then you had taper tantrum, then you had demonetization, Russia, Ukraine, Liberation Day, so on and so forth. What we learned is quite interesting, that when the crisis is ongoing, Nifty typically trades between long-term average and -1 standard deviation. That's the valuation band that it goes to. And once the crisis is over, it shoots higher than the long-term average. Now, currently on our numbers, which as we just discussed is much lower than Street is at 15, we are at 8.5. On our numbers, Nifty is already at long-term average. So we are on the higher end of the band during the crisis period valuations. And if these valuations sustain, we do think that there is a 15% upside to the markets from current levels. But in the bear case, if the valuations do go to the lower end of the band, which is -1 standard deviation, then we could potentially see a 8% downside. So even if we work with a -8 plus 15, we think that the risk reward is now favorable. So our tilt for the market is now more optimistic rather than looking at the bear case side. Having said that, even with the 15% upside, Nifty would end the year with 26,200, which is our year-end target, which is a flat market for the whole year. And therefore, we believe that India will continue to underperform the emerging markets this year.
Okay. Got that. So now, simple question, Amish. For investors sitting on cash, what is the advice? Invest right now, and if
advice is that they should. I would argue, to my point, that these are attractive levels. One should start deploying. You may not want to deploy all because clearly till the time the conflict goes on, there could be a bear case, there could be a worst case. What if there is an actual further impact to the energy infrastructure? So those are events that we cannot predict as of now. But clearly, these are attractive levels. There are pockets, so the other thing that we are arguing is that we cannot yet comment that India is deep value, but India's valuations is now definitely reasonable. So at reasonable valuations, if you're okay to take some downside risk, and if you're genuinely in for 1 year, 3 year long-term kind of investments, I think it is time to start deploying.
All right. Hi, Amish. But if I got that correct, you're saying India continues to underperform the emerging markets, right?
That's right, Nigel. Because from current levels, we are talking about a 15% upside. But 15%, or in other words, markets like China, Korea, Taiwan would probably do better than 15. And 15, remember, is a rupee return. Adjusted for the rupee depreciation, we do believe that the other markets would outperform India.
Okay, got that. In fact, if I look at the underperformance from India and we plot it in dollar terms, India is at the cheapest levels or at the same level that we saw in absolute terms in 2021, what we saw because of the kind of depreciation we have seen in the rupee. That said, there'll be a few top sectors that you continue to like, right? If you could name the top 2 themes that will outperform from here on.
So I think, the interest rate sensitives play both sides. So the ones that are beneficiary of the rate hikes, which is, banks or the large private banks as well as the PSU banks, we think they benefit. But obviously, the ones which are at the receiving end of the interest rate hikes, like NBFCs, mid-sized private banks, passenger vehicles, real estate, all of that are going to get impacted. So that's one theme. The second, we are of the view that governments will have no choice but to focus on energy security. And from an energy security perspective, the entire power value chain basket, which includes transformers, cables, power generators, coal, so on and so forth, even power financiers. So all of that we think is going to benefit. Biofuels is another energy security that we can work on, and that I think will benefit. So those two. And outside of that, we always were of the view that the well-off Indian consumption basket is going to outperform the mass consumption basket. So that as a theme stays. And then finally, within CAPEX, broadly we are bearish. There are only some pockets of opportunities within CAPEX like defense, shipbuilding, power that we spoke about. So minus some pockets of CAPEX, we are by and large bearish on CAPEX as well.
Yeah, Amish got that. And we'll put those sectors up out for our viewers as well in terms of sectoral views. Just wanted to get a sense from you on what the feedback from foreign investors is really, Amish. Both on equity and the rupee has seen so much action, right? The RBI coming in heavy with measures, actually measured and then another measure to make sure it works. The first measure was worked foolproof and it did on Thursday. So just your thoughts on both.
So Prashant, I guess, at the start of this year, when AI was the main theme, clearly most investors, foreign investors that we spoke to, wanted to play more Korea, Taiwan, which is a direct play on AI from a memory and a chip perspective. India was not so much on radar. And obviously the common complaint was India's valuations are too expensive. So if I can get a Korean market at 7 times PE multiple gives me 100+% earnings growth. If I get Taiwan at 18 PE multiple gives me 35% growth. Then why should I bother about India with a 14% growth and a 20+ PE multiple? So that was a debate. Since that time, I would say, as we know, Indian valuations have got much reasonable. So India is now starting to come up in discussions. Most investors are again warming up to India. They are trying to look at subsectors and themes and sectors which have become value. So I think interest on India is coming back, but it's not as if that they are giving up on Taiwan, Korea, China completely. So I think now India is in the mix versus being out of the mix is the way I would think about it.
And the rupee thing, Amish, any feedback?
So rupee, large part of the depreciation has already happened. Again, obviously, unless there is a massive impact on the energy infrastructure because of the war, most believe that a large part of the rupee depreciation story is now coming to an end, especially with RBI being so proactive. So rupee was a concern that if I, to my point, if I make a 15% return, but if rupee depreciates by 5, then I've only made 10% that I take back home. So with rupee depreciation story mostly coming to an end, there is some comfort on that side as well to look at India favorably.
And that $100 oil was what India, your assumption, what India will pay to buy oil for the rest of the year, right?
No, so this is the global commodity forecast, meaning as we all know, India pays a bit of a premium for the kind of crude that we purchase. But then given that Russian crude is allowed again, some part of that premium gets offset with the Russian discount as well.
Yeah. So, and the rupee, you're saying that if it stays at 100 and we pay whatever, I mean, last week, we spoke with, I think it was an oil company, said our cost right now is about $115, $120. So, say 100 to 115 or so. I mean, you're saying if it stays here, and that's the largest variable, the rupee, we've seen the worst for the dollar rupee, according to you, Amish?
Yeah, so our house view, meaning I'm not an expert on rupee, Prashant, as you know, but our house view or our forex analyst view is that rupee will end at 93 by the end of this year, which is broadly where we are today. So that's why I was making a comment that large part of the rupee depreciation problem seems behind us.
Okay. Amish, just a couple of questions on your calls in individual sectors. Given the rupee depreciation, is IT looking attractive to you now? Tactically, what is the call?
Rima, till the time the conflict goes on, I think IT is a great hedge, and that is a good sector. If I'm a foreign investor, I would want to hide in, because even if one believes that there is a disruption coming, disruption is not coming in the next quarter. It is coming over a period of time. But in the near term, obviously because of rupee depreciation, earnings growth has more visibility, and earnings growth will get upgraded for IT. So I think IT outperforms till the time the conflict goes on. But as a house, we are of the view that the disruption of AI is for real. First, there will be a growth impact because of AI disruption, and the benefits of AI-led growth will come with a lag. So IT, by and large, we are underweight, even on a bottom-up stock basis. Obviously, there are a couple of stocks on a bottom-up basis that we like within IT. But broadly, from a strategy perspective.
Got it. So structurally, you're still underweight on IT, but it will do well. It'll be resilient, good hedge till the conflict is ongoing. And you were, when we last spoke in November, you were overweight on rate sensitives. And now you're saying rate sensitives like banks, autos, etc. will see the biggest earnings downgrades as the RBI looks to hike rates. So what is the call now on rate sensitives, and where do you see a valuation disconnect now?
You're absolutely right, Rima. So back in November, the view was that large part of the fiscal stimulus that the government could give in terms of direct tax cuts and GST cuts was already given. We did not see scope for growth stimulus coming from fiscal. We did think that there is plenty of stimulus that can come from monetary, and therefore our view was that there will be more rate cuts. However, because of the Iran conflict, clearly there is inflation. Inflation is now a real issue. And on the back of inflation, we do think that there could be 50 basis points of rate hikes now. And therefore, we have switched our call to being bearish on rate sensitive versus what we were in November last year.
Okay, bearish and rate sensitives versus being overweight towards the end of last year. So that's a dramatic cut in the view. Even on banks, where there is valuation comfort? All right.
So banks actually, Rima, benefits from a rate hike, as you would agree, because NIMs expand. So we are positive on the private banks and the SOE banks that actually benefit, but we are negative on the mid-sized banks which have a higher exposure to MSMEs, MFI, etc., which could be problematic as the rates go up, and NBFCs where NIMs compress because of rate hikes. So NBFCs, mid-sized banks, insurance, housing finance is all in our bearish camp or cautious camp, and the PSU banks and the large private banks is what we prefer.
Amish, great conversation. Thank you very much for joining in. That's the call coming in on BofA, lowest on the street when it comes to earnings expectations for FY27 at 8.5%. Let's talk about Pharma, 100% tariff on branded Pharma. Ekta joins in with more. Ekta.
Thanks for that. Well, yes, it was definitely a busy weekend when it came to the entire pharmaceutical space. So the US government has announced a couple of announcements with regards to pharma. So the first is that the US government has announced a 100% tariff on imports of branded pharma as well as its ingredients. It is applicable where companies have not entered into a prior agreement with the US government. The branded imports from countries such as Japan, Europe, Korea, Switzerland, etc. are subject to around a 15% tariff only. So it's lesser than that 100% tariff. Secondly, generics, associated ingredients for generics and biosimilars are exempt from tariffs as of now, but they will be reassessed in 1 year. Now, the impact for the first, which is the branded 100% tariff on branded pharmaceuticals, for Sun Pharma, it is expected to be an impact. But remember that significant portion of Sun's manufacturing of branded generics could possibly fall under the exempt jurisdiction. So, for example, a couple of drugs such as Zelpros as well as Sezaby are manufactured in India, so those could be impacted. But overall, the other ones are manufactured in exempt jurisdictions. So the estimated impact could be around 1 to 2% of revenue for Sun due to the branded tariff situation. Now, CDMOs, Divi's, Loris, Syngene, OneSource, minimal implications for Indian CDMOs because the tariff burden is absorbed by the innovator companies. And lastly, generics such as Cipla, Lupin, Dr. Reddy's, Glenmark, Biocon, as well as Sun Pharma, the overhang continues because the US government will be reassessing tariffs in a year's time.
All right, thank you very much for that. Let's move on and invite the management of Supreme Industries on the show now. The government on 2nd of April said that they're granting full customs duty exemption on critical petroleum products. This is on account of the conflict in West Asia, but this is a temporary measure. It's going to be in place only for 3 months. MP Taparia, MD of Supreme Industries, is now joining us on the show. Thank you very much, sir, for joining in. This is Rima here. Can you tell us how this news directly benefits Supreme Industries? Which are the products that you use, which are now exempt from this import duty?
I can talk about the general Indian plastic industry. The import duty reduction is for the critical plastic raw material required for packaging, agriculture, healthcare, housing, and infrastructure. And the polymer prices last month of March, after the 20th February attack, has gone up more than around 50% of the commodity polymer international price. So as they are very critical raw material, the government in their wiseness have given a relief for 3 months of making import duty zero on all plastic imports. How it affects our company, that we will talk when we adopt the account, our annual account in the month of April.
So I understand you'll give, you'll explain to us in greater detail once the numbers are out in a month or so. But can you give a broad indication of the kind of benefit? And after this has been passed, have we seen a reduction in polymer prices?
Broadly, it will benefit element in our plastic industry. And we are also part of plastic industry. So we will also benefit because the country has to import plastic raw material. Unfortunately, for this critical material, country is short. 20 to 22% of polyethylene and polypropylene required from imports, and in PVC, 68% required from imports. So import duty reduction for 3 month period is to just give some relief from the international price increase. The problem continues that Gulf market is very much affected, and so they are not able to export anything to the world market.
All right. Hi, Mr. Taparia. Good morning. Good to see you. When, sir, prior to this notification, what was the import duty you were paying on some of these raw materials?
On all the raw materials, the duty was 8.25%.
8.25%.
Okay.
Is that correct, sir?
That has been made zero.
All right. Got that. A couple of other questions, sir. As you have been saying that the prices have moved up, but you as well would have been taking some price increases, right? So what is the quantum of the total price increase you have taken on the selling product in the last quarter?
That we will discuss when we adopt the accounts.
For the industry, sir, for the industry on the whole.
Now, overall, anyway, the country has to increase the product prices. But on my company, I will discuss only in the last week of April.
Okay. Can you give a broad indication, sir, how Q4 has been for you in terms of volumes, in terms of margins?
But we are talking more about Supreme Industries. What I can tell you.
Okay. All right. So we'll...
Reduction in import duty gives relief for the cost of raw material. No?
Agree, sir. Agree, sir. But you're unable to share the quantum of relief right now, for your company at least.
Now, my company, I can talk only last week April.
Okay, all right. So one more quick point. You know, in the past quarter, that there has been that removal of China's VAT export rebate on PVC. Many believe that this is a structural positive for the domestic industry here in India. How do you read this?
Oh, yeah, PVC is a very critical situation. The country is too much dependent on imports. Country requires today 68%, 70% imports.
Okay.
PVC is very vital raw material, but India's own production is very small. We all are dependent quite a lot on imported product.
Yeah. Mr. Taparia, and so or for PVC, good morning, sir. Compared to 1 month ago, how much are imports down by? Are they down?
No, I can say the PVC price here internationally gone up by 48% in the last 1 month.
48%?
Yes.
Right. And availability is not an issue at all?
Availability is not at all issue because you are able to import. China is a big supplier to Indian market.
Yeah. There was an import duty which was imposed as well, right, sir, for PVC?
Sorry?
Was there an import duty which was imposed as well for PVC sometime back?
Import duty 8.25% all plastic raw material.
Okay, that's the standard. So my question was, across the petrochemical value chain, and this is not a question about Supreme, but we are constantly hearing of disruption across that value chain in producing countries. China, of course, has been, in a way, insulated so far. They're a large producer of most of these things. But is there any disruption in the value chain, sir, for things that Indian industry imports? And where is that the most severe, if it is so?
Disruption is mostly on the import coming from Gulf countries and from Far East Asia and Southeast Asia. They were also dependent for their feedstock, so their production has been very much affected. But China is a big producer, not based on crude oil. They make a lot of polymer based on carbide, that is from coal base. So China is not affected in PVC and polypropylene because they make quite a large volume from carbide, which is coal-based feedstock.
Wow. So
but other countries are very much affected.
Yeah. No, point taken, sir. We'll leave it there. Thank you very much for joining us, Mr. Taparia. It's always a pleasure, and appreciate your time here on CNBC-TV18. As always, we'll take a quick commercial break here. That's the color on what's happening right now. And that's something we've heard from others as well. In the midst of all of it, what's China kind of sort of, in a way, emerging as a bit of a anchor for stability with regards to supply, because they've got so much excess capacity across a range of things. So, they're able to sort of supply markets here in India, in other affected markets as well. And maybe their share in each of these industries perhaps also higher compared to about a month ago. We'll take a break here. We're going to come back and we will focus on that other big story which came through, which is the reintroduction of open market buybacks. The industry has welcomed it, market participants have welcomed it. Pranav Satya of EVA India and Bhavesh Shah of Equirus Capital with us in just a bit.
Welcome back. A couple of stocks that Prashant had pointed out as well earlier were CPCL that's under some pressure because OMCs are likely to pay discounted rates to refiners. Sonal joins us to run us through that data point. Sonal?
Thank you so much for that. Well, it is an important update which is coming by. It is a deregulation of sorts which OMCs are implementing for whatever fuel they buy from refiners. It is first of a deregulation that we are seeing since the time these prices were regulated. Fuel will be sold below cost to protect consumers from price spike. This is something that we've seen already. There's been an excise cut, but now all marketing companies will be buying petrol and diesel or other fuels from refiners at a discounted price. And the discount go to as much as 60 rupees a litre on fuels, and that means that would be a big margin pressure for standalone refiners, the likes of MRPL, Chennai Petro, all of them, because they're standalone refiners. Their gross refining margins will be hit because of the discount that they're giving to all marketing companies, because they're already taking a big cut in terms of marketing margins. And that is the reason these stocks are under pressure, and they will be in focus because it is largely an impact on private refiners, which are taking a hit as far as their selling price is concerned.
So Sonal, and this is like an official notification which has come, or this is kind of sort of happening now?
It is. There is no official notification for this. Usually you don't see notifications for pricing cuts unless they are coming from the government. So this is decided internally by all marketing companies, and this is a PTI story, a report which suggests that this has been happening, and it floated back in February last week when the war started as well. But now they have given numbers of a 60 rupee discount that has come by, but no, there is no official order that has come for this.
Yeah. I mean, it kind of, it was to be understood in that sense, right? Because jet fuel prices, for example, the hike was capped, although the actual cost had gone up quite a bit more. So somebody has to take that knock. And that somebody, right, for now seems to be refineries and refiners.
That is correct. That is correct. It will be, and mostly because standalone refiners only have refining segment with them, right? Yeah. For all marketing companies, they have two segments. So it's largely on those standalone refiners like MRPL and Chennai Petro.
Yeah. Okay. All right. Sonal, thanks very much for that. So that's an important story, which we continue to track. And I think it's an unusual situation, and there are some unusual measures which, of course, are being put into place. I mean, the basic aim seems to be to prevent the complete pass-through of everything, all these price increases to the end consumer. So somewhere up someone up in the value chain, the government or the PSUs, will have to take the hit, and we'll see how it continues to get distributed over a period of time. Well, there are some big shifts in the capital market regulation. SEBI is considering revival of open market buybacks, and I think that news was received very, very positively. Pranav Satya is partner and national leader, International Tax and Transaction Services at EVA India, and Bhavesh Shah is managing director and head of investment banking at Equirus Capital. Gentlemen, great having both of you here. Appreciate your time. Bhavesh, I can ask you to comment on this first. As I said, news was received with, if I can say, loud cheering. Otherwise kind of dull environment all around. What's your sense, Bhavesh? How consequential can this be?
Hey, good morning, Prashant, and thanks for having me here. I think, as you rightly said, this is a very positive move, and I think the timing of this is also immaculate. It aligns with a lot of stars because, one, of course, there was a good amount of change which was done on the tax side of which, and then even the market conditions, given the volatility in the market right now, this provides one, way where companies can actually use their surplus cash to not only efficiently buy shares, but also at a good price. and which effectively, creates a good amount of, increase in the EPS and the long-term value creation for the companies. This is it's globally accepted method of buying shares on the open market, which India was kind of, getting deprived of because of various tax regime, the way the buybacks was done. I think the government has taken including the finance ministry, including the SEBI, they have taken very proactive measures to kind of get this implemented. So I think kudos to the governing bodies to get this thing done. I think now it is for the companies to kind of take advantage of it, and even from a retail investor, this is a great. Earlier it used to be a panic selling which used to happen in the market. Now there's someone in the market out there to kind of really, I would say, buy the shares at good price. So this is a really win-win from both company standpoint as well as the investor standpoint.
Pranav, sort of first thoughts from you, and just in terms of how this will give the shape of how this will work. Do we go back to how it was before this was disallowed in the same shape and form?
So my sense is that SEBI is talking of having good checks and balances and safeguards. So we will have many of the safeguards that they have put in place when they put in place the glide path, so to say, back in motion. But I think overall what it does is it enhances liquidity. It ensures that so far as companies are concerned, they are able to absorb the selling pressure which might unreasonably come through at certain points in time, maybe as at the present. So it's something that is internationally well accepted, open market buybacks. And in India, it was possible till 23. Thereafter, there was a glide path and it was completely discontinued from April 25. I think the key is that the taxation regime has changed quite a bit. And that was the major reason for SEBI trying to, so to say, have a glide path and then completely discontinue open market buybacks. And that was because it was very difficult to identify the shareholders who had sold shares which were bought back by the company. And in such cases, the taxation regime provided that the shareholder will be exempt from capital gains tax and the company will pay a buyback tax. That regime continued till September 2024, after which we had the dividend taxation regime. The challenge with the buyback regime when it existed was that while shareholders who tendered shares or sold shares on the open market and were bought back by the company were capital gain exempt, the other shareholders whose shares were bought by not the company but other buyers in the market were subject to capital gains tax. So it resulted in some form of inequity. And that's where this whole thing was discontinued by SEBI as not being equal and fair for all the shareholders. So I think now there is a clear regime where shareholders, other than promoters, are subject to a long-term or short-term capital gains tax, as the case may be, as per the normal capital gains tax regime, irrespective of whether the shares are bought back by a market participant or by the company itself as part of the buyback process. So therefore, this new tax regime certainly facilitates it. My sense is promoters, persons in control, like in the earlier regime, will not be allowed to tender shares in the buyback process under the new regime. The exact rules have yet to come. This is more for public comments that SEBI has released these particular guidelines.
That is one safeguard. Anything else? Any other important ones you would imagine, Pranav?
Oh, yeah. So for example, they are very likely to say that in the first 30 minutes and the last 30 minutes, buyback cannot happen, which again, I think is an important safeguard in as much as it prevents any form of price signaling or closing price manipulation by a company. And this is internationally also quite well prevalent. The time, whether 30 minutes or whatever, can be debated, but otherwise, yes, opening, closing, companies will not be allowed to participate is the sense I'm getting. Also, they will not allow the company to be price setters. They will allow the companies to be price takers, which means on any given day, not more than 25% of the shares traded in the past few days, average trading volume for the past few days can be done through a buyback, so that the company is a price taker, it does not become a price setter. Similarly, they will, I think, provide that more than certain percentage cannot be bought back, so that it does not crowd out private acquirers who want to acquire on the market. and so on and so forth. So there will be all kinds of restrictions, plus minus 1% of the last traded price and so on. So there will be all of these safeguards, I assume, in order to ensure that there is a fairness and transparency built into the process or the mechanism of open market buybacks.
Bhavesh, or as you heard Pranav, anything you want to add in terms of safeguards or how this will finally look? This is a consultation paper for now.
Yeah, absolutely. It's a consultation paper, and as I said earlier, I think SEBI is very, very conscious about whether this new regimes are taken being taken advantage of by certain set of shareholders. What SEBI wants to do and what the regulators want to do is to make sure that it's completely equitable, it's completely fair, it's completely transparent, without impacting prices in the market. And it should be true to what the spirit of the buyback should be, and rather than being manipulated. So I think these safeguards, which were highlighted earlier by my colleague, I think they are very, very important. They make sure that there is no, and for example, there is something known as an order matching system. So order matching system is not allowed. So you basically are ensuring that you cannot use the stock exchange route for one buyer to buy from another buyer in a targeted manner. So that I think is a very important consideration. Plus the timing changes and the 25% rule in terms of trading. This makes sure that there's no price disturbance which is created through this, and it is done in a very nice and efficient manner. I think this is what SEBI has been trying to do.
In your sort of interactions, etc., Bhavesh, is there going to be taken up quite if this goes through, it's going to be taken up quite aggressively, and by who? Which lots of cash-rich companies out there. So just give us a flavor of what you are sensing.
So I personally feel, yes, I think this will certainly, it's a very positive move and is certainly being considered very actively by a lot of companies. Of course, it's a consultative paper right now. It has to convert into a proper framework before this is actually implemented. But you're right, absolutely, Prashant. The cash-rich companies which have good frequently traded shares, which basically, the stock price has been has come down significantly, so there is a value in the stock price. I think these companies will definitely want to take up. I think if you were to, without naming companies, broadly sectors which could take really advantage of this could be, IT sector where the stock prices come down. They're cash-rich businesses, very frequently traded shares, large caps, and then a lot of the sectors. Pharma could be another one where again there's good cash reserves, and the prices may have been corrected, and there's scope to do a buyback there. But a lot of companies who generally need cash, so broadly in the financial services sector, or some of these companies will not consider this, like in the real estate companies, the new age companies who always need cash, and some of the the businesses which always need cash to grow. It will be more considered by some of the FMCG companies, the consumer companies, the high-tech services companies who generally throw out cash, and wherever they see value in the stock price to buy back. I think those are the companies who will go on for this.
Is it possible, Bhavesh, to recollect at a point in time in the past when you had an episode of markets panicking, and when the open market buyback was allowed? I mean, what's the what was the size of this route that companies use? I mean, how much was bought back through this route during one of those phases?
Yeah, no, I think it's just jogging on the memory lane, Prashant. I think when this was done earlier, I think, many times just the signaling of the buyback, by the companies ended up stabilizing the prices. So there was always a buyer in the market who would buy the shares when the prices had cracked. And just that signaling that, yes, companies there to buy the shares at lower price, that itself created some kind of cushioning. So I remember some companies, I can't remember, I can share the names, but some of the companies already had, whatever buyback mechanism that or the buyback amount they had earmarked, they were not able to use that, and which is why one of the regulations came then subsequently, which that so much money has to be used. But there was a time in the past when just the signaling itself really helped the stock prices.
Yeah, no, absolutely. Pranav, anything you want to add to it?
So India does have some unique features, like, for example, very large promoter holdings in many companies, large retail, small shareholder base. So in a tender offer, for example, there is a 15% earmark for small shareholders holding up to 2 lakhs. All of those are not available. Companies which want to show a signal of a premium being paid for the price will still go through the tender offer route, because the buyback through open market is normally at the market price. And companies where the stocks are not very liquid will still have to go through the tender offer route, because I don't think, unless the shares are very frequently traded and very liquid, the open market would work well. But otherwise, the speed and simplicity with which this gets implemented, the kind of pricing is not premium, and therefore the company is able to buy back shares at the ruling market price, and so on. So those are really good features of permitting open market through buyback. So I think there is place for both, but the flexibility, speed, and simplicity of buyback through an open offer on the stock exchange is much, much better.
Yeah, absolutely. We'll see, as the final guidelines come through, and but great conversation and good insights, both of you, Pranav and Bhavesh. Appreciate your time here on CNBC-TV18, and we'll have you back once we have the final guidelines from the regulator. But much desire, and of course the regulator now moving forward with that consultation paper. 140 points, by the way, down on the Nifty. We're at about 22,570. Nagaraj Shetty is with us with what he wanted to do with regards to trades. We're at the day's low. Nagaraj, just thoughts on the index trades and your stocks?
Hi, good morning, Prashant. The way market has reacted on the recovery in the last two sessions is indicating that buying seems to have emerged from the lower levels. 22,200 seems to be important bottom as of now, and the current consolidation is likely to end soon. And very soon, I'm expecting Nifty to reach up to 22,800, 23,000 levels, which are the next important hurdles in the next, at least by this week.
Okay, looking at higher levels. Got that, Nagaraj? What about individual stocks?
Yeah, I have two stocks from long side. First one is Coal India. Coal India has been in a sharp uptrend over the last few months. What we observe is higher tops and bottoms and consolidation patterns from the higher levels recently. And after the showing some consolidation, it has started to move up from the lower levels from the important sub.
Okay, thank you very much for that. Senco is a stock which is surging now. Senco Gold is up 12%, very large volumes. The Q4 update, the street likes. The company is guiding for a 46% revenue growth in Q4, led by a strong wedding season. Same-store sales growth, according to the business update, is 34%. And the total stores have also now crossed 200. So Senco is reacting very positively to that update. And in the large cap space, it's trend 5% up now on trend. If you look at the revenue growth this quarter at 20%, it's the best that they've seen compared to the prior few quarters. So that's keeping the stock excited. 5.5% up, but it's still down 40% from its 52-week highs. Get into a break on the other side. Manisha will talk commodities. Welcome back. Let's talk commodities. As promised, Manisha Gupta is now joining in. Hi, Manisha.
Thank you for that. I'm looking at crude oil prices because we are holding around that $110 a barrel. Earlier, 100 was a mark that you were following. Now it's 110. So we're making higher highs when it comes to the crude oil prices. This is after there's a deadline for Iran to reopen Hormuz, and there's an extended time till 8 p.m. Tuesday is what the U.S. president has come out with. So markets clearly reacting to that in sense of a geopolitical premium coming in there. The U.S. also is threatened to hit civilian infrastructure if Hormuz is not opened. And Iran, in the meanwhile, is known to have rejected the U.S. demand. So we'll know what the day-to-day looks like. But at this point in time, as you can see, just about holding that 110 and below that right now. Interestingly, the markets also seem to be reacting to the OPEC Plus statements that came in over the weekend. OPEC Plus says that the war-related damage to energy infrastructure could have lasting repercussions. OPEC Plus also said that they are looking to increase output going forward in sense of their member quotas. And once Hormuz reopens, that is, because at this point in time, most of the OPEC members really are within the Middle East. So whether you talk about Russia, which actually is facing sanctions, but then you also have Saudi Arabia, you have UAE, all of those countries are able to just about get out very limited crude oil from Strait of Hormuz or to the rest of the world, and that really has an impact there. Interestingly, you also have the war removing almost 12 to 15 million barrels per day, or 15% of global supply, and that's what the street is reacting to. There also is prices trading in the premium right now. So when you look at the U.S. crude, we are looking at 2025. The U.S. produced nearly 21.7 million barrels per day, and that is inclusive of 13.6 million barrels per day of crude oil, and it also is about 8.1 million barrels per day of natural gas, and of course biofuels, etc. So when you look at the overall U.S. numbers therein, you're looking at U.S. producing 21.7 million barrels per 2.8 million barrels per day of light sweet crude is what U.S. exports. The reason you're looking at WTI trading higher than Brent is exactly this, because the U.S. is exporting 2.8 million barrels, but U.S. also is importing a much higher quantity at around 6.2 million barrels, which is heavy crude. This comes in from West Asia, Canada, Venezuela, Mexico. So the reason you have the crude prices in U.S. and Middle East, both of them trading on the higher side. Now, there are various reports suggesting that a lot of government rationing is happening when it comes to fuel consumption. Indonesia, for one, daily fuel purchase is capped at 50 liters per car for the private consumers. For the government workers, they have been told to work from home. It's a similar situation also coming in from Thailand, where there are reports that they're preparing for fuel rationing plans. And then you have Bangladesh, where there are a lot of rations in effect already there. The universities are closed, and Bangladesh also is a country which imports 95% of its consumption, doesn't have too much crude oil remaining, and we're looking at prices surging there. Slovenia, one of the first European countries to start setting 50 liters daily limit for private drivers there. And there are various reports also suggesting that EU's Energy Commissioner to FT has said that rationing is being considered as an option if this continues going forward. So that's exactly, pardon me, what the markets are reacting to. Higher crude oil prices, with JP Morgan to Goldman Sachs and MS all saying that if this continues for the next couple of weeks as well, we are perhaps looking at 120, 135 kind of levels.
Right. Manisha, thank you very much for that. That's commodities and focus oil in particular. We'll take a break. We're back. And we discuss RBI steps so far in terms of reining in the, excessive speculation around dollar, rupee, INR, derivative contracts. Success, of course, on Thursday with that sharp appreciation in the currency. This morning, of course, holding on with those gains. We'll, of course, also talk about the upcoming policy, the RBI policy decision on Wednesday. Latha speaks with Pranjal Bhandari of HSBC and Mithul Kotecha of Barclays coming up in just a bit.